As a financial advisor, one of the questions I'm asked the most is which accounts should I pull funds from first in retirement? The answer isn't what most people think, and getting it wrong can mean paying a lot more in taxes than you need to. This mistake has cost retirees tens and hundreds of thousands of dollars. Today I'm going to walk you through how to structure your retirement withdrawals step by step so you can keep more of your hard-earned money and worry less about running out. Let me explain this using something we're all familiar with. Imagine you have 3 different piggy banks. Each one has different rules about how much tax you'll pay when you take money out. The first piggy bank, let's call it your tax-deferred account, like a traditional 401k, traditional 403b, or a traditional IRA, gives you a tax break when you put money in, but you'll pay full taxes when you take money out. The second piggy bank, your Roth 401k, Roth 403b, Roth IRA, doesn't give you any tax break up front, but as long as you follow a couple simple rules, everything you take out is completely tax-free. I've got another video on understanding Roth IRAs. I'll leave a link to that video in the description below. The third piggy bank, your regular investment account, we've already paid taxes on the money that you contributed to that account. But when you take money out, you'll probably owe some taxes on the growth in the account or capital gains. Now, after 30 years of helping people manage their investments and plan their retirements, I can tell you that choosing the wrong order to break open those piggy banks can cost you dearly. Before we talk about which account to tap first, we need to understand what other income sources you'll have in retirement. Let me help you break this down into 3 simple steps. Step 1 is listing your guaranteed income sources. This includes Social Security benefits, any pension payments, any annuity payments, and rental income if you have it. Think of these as your retirement salary. They're going to show up like clockwork, whether you do anything or not. Here's what's interesting though, and here's where a lot of people make their first mistake. They don't consider when these different income sources will start. For example, you might retire at 62, but defer Social Security payments until 67 or 70. That time gap will make a huge difference in your withdrawal strategy. Now let's talk about what I call the gap. Let me give you a real example I see often. Say you need $80,000 a year for a comfortable retirement. Let's say Social Security will provide you $30,000 a year, and a small pension will provide you another $10,000 per year. That leaves a $40,000 a year gap that you need to fill from your various investment accounts. Here's where it gets interesting, and I want you to really understand this because it's crucial. This gap isn't just about the numbers. It's about understanding how taxes will impact each dollar you withdraw. I'm talking about developing a tax-efficient withdrawal strategy. That means pulling money from your accounts in a way that lets you keep more and lets you pay less to Uncle Sam. Let me help you to understand why the traditional withdrawal approach might be costing you money. You've probably heard financial advisors say that you should drain your accounts in this order. Taxable accounts first, then tax-deferred accounts, and finally tax-free accounts. Let me explain why this isn't always the best approach. Think of it like traffic lanes on a highway. The traditional approach puts all of your money in one lane. But what if that lane gets backed up with traffic, or in this case, higher taxes? Here's what typically happens with the traditional approach. Let's say you retire at 62. You spend the first several years draining your taxable accounts, feeling good because you're only paying capital gains rates. But here's what people don't realize, and I've seen this countless times in my 30 years as a financial advisor. You're letting your tax-deferred accounts grow bigger and bigger. Now, why is this a problem? A little thing called required minimum distributions. Now let me explain what happens. When you hit 73, the IRS is going to force you to start taking money out of those tax-deferred accounts. And because they've grown untouched for years, those forced withdrawals can be massive. Following this traditional account, a lot of investors are forced to take out $80,000 or $100,000 a year, money they don't even need, and it's all taxed as ordinary income. Not only that, but these large withdrawals can push them into higher tax brackets and even cause more of their Social Security to be taxed. Instead, let me show you a different approach. Think of it like using all the lanes on the highway strategically. You want to balance your withdrawals across your accounts based on your tax situation each year. Here's what I've found works best after helping hundreds of people manage their withdrawal strategy in retirement. I call it the strategic 3-lane approach. Lane 1, your tax bracket sweet spot. Let me explain what I mean. Each year, you want to take enough out of your tax-deferred accounts to fill up your lower tax brackets. For example, if you're married and filing jointly in 2025, you can have up to $96,950 in taxable income and still stay in the 12% bracket. Now, don't let the numbers overwhelm you. The concept is what matters here. If your Social Security and other income put you at $50,000, you've got room to pull $46,950 from your IRA at that lower tax bracket. Lane 2, capital gains strategy. Here's where it gets interesting, and this is something most advisors won't tell you. After you've used that lower tax bracket space, then you can pull from your taxable account. Why? Because long-term capital gains are taxed at preferential rates. And in some cases, you may pay zero taxes on these gains if you manage it correctly. Lane 3, Roth flexibility. Your Roth accounts become your safety valve. If you need more money than you've pulled from the other two lanes, you can take it from your Roth without worrying about tax implications. Let me give you a real-world example. I have a client, let's call him Bob. Bob needed $70,000 a year beyond his Social Security. Instead of pulling it all from one account, we took $30,000 from his IRA to fill up his lower tax bracket, $20,000 from his taxable account, which only generated about $5,000 in capital gains, and $15,000 from his Roth IRA for the difference. This strategic approach saved Bob over $8,000 in taxes the first year alone, compared to if he'd followed the traditional method. Now you might be thinking, this sounds great, but how do I actually do this? Let me break it down into a simple framework that you can use each year. First, look at your guaranteed income, Social Security, pensions, anything that you know is coming in. This creates your baseline income. Second, calculate how much room you have left in your current tax bracket. This is your IRA withdrawal sweet spot. And let me tell you, this is where most people miss a huge opportunity. And third, consider using your taxable account for any additional needs up to the capital gains threshold. And finally, keep your Roth as your backup plan for any additional expenses. The beauty of this approach, and I've seen it work time and time again, is that it gives you flexibility while keeping your tax bill as low as possible. You're not locked into one lane. You can adjust based on your needs and tax situation each year. Before we wrap up, let me share with you the 3 biggest mistakes I see people make with their withdrawal strategy. 1, not considering required minimum distributions. Remember those traffic lanes we talked about? RMDs are like a forced lane change. They could push you into heavy traffic, or in this case, a higher tax bracket. 2, ignoring the Social Security tax torpedo. That's what happens if your withdrawals cause more of your Social Security to be taxed. I've seen this surprise too many retirees. 3, missing opportunities for Roth conversions. Think of this as having the opportunity to move your money to the express lane before traffic gets heavy. We've covered a lot of ground here, so let's quickly recap what we've covered today. We started with understanding your 3 types of accounts, your 3 piggy banks. We talked about identifying your retirement income gap. We covered why the traditional approach might cost you more in taxes. And most importantly, we walked through the strategic 3-lane approach. Remember, while these strategies work for most people, everybody's situation is unique. That's why it's important to understand these concepts and apply them to your unique situation. The key is to be proactive. Don't wait until you're forced to start taking RMDs to start thinking about this. The earlier you develop your withdrawal strategy, the more options you'll have. Thanks for watching, and remember, it's not just about how much you've saved for retirement, it's about how smartly you use what you've saved for retirement. To learn more about Roth versus traditional retirement accounts, watch these videos next.